Hi, I'm Michael Gable, Managing Director of Fairmont Equities. Bond yields have marched higher over the past few weeks, and with that the share market has headed lower. You'll notice that everybody's talking about rates being higher for longer. That seems to be the common catchphrase at the moment. The problem with people in general when it comes to looking at trends is they extrapolate in a straight line. So when interest rates were at zero, we thought they won't go up for another few years until 2024. Now that bond yields have been heading higher over the past several weeks especially, everybody's saying that they'll continue to head higher and rates will stay higher for longer. Now let's look at the reality of how this will play out. Now just a reminder, any advice is general only. This is the US 10-year bond yield. Now yields across all timeframes are looking fairly similar, but essentially what we're looking at here is over the past 6 months, there was a period where the yields were heading higher, but in a fairly sustainable fashion. But you'll notice that over the past several weeks, it's started to head up almost vertically. So this basically leads to what's known as a blow-off top. So often at the end of a trend, you get this sort of, in stocks, we refer to it as fear of missing out. You get this huge move up that heads up in a straight line, but they always end the same, and that's, the bubble bursts and they move down just as quickly. So this is the 10-year bond yield on a longer term time frame, so looking back over the past 50 years. As we could see, history has shown that yields go up sharply and then they come back down just as sharply. So for yields to head up sharply and then move sideways, that would be pretty remarkable. As I mentioned earlier, vertical moves up result in vertical moves back down. So I cannot see a period where rates will be higher for longer, they overshoot on the upside, and then they come down just as quickly. As this chart shows, you've got this sawtooth action, moves up, sharp moves down, sharp move up, sharp move down. So quite simply, if we put things into perspective, two reasons why the yields will not continue to stay up at these elevated levels. Firstly, vertical moves up always end in vertical moves down, and we can only look at the past 50 years of bond yields to see that there's never been a period of time where they've stayed higher for longer. Higher for longer sounds great, it's a great catchphrase, but it's completely unrealistic. So there'll be a period pretty soon where the bond yields come down just as quickly as they've headed up in the past several weeks, and this will lead to a fall in the US dollar, and it will lead to a rally in equity markets. If you're looking for more ideas, head to our website fairmontequities.com and sign up to the free trial. You'll get our market outlook, our trading guide on how to buy and sell shares, and you'll also get 8 weeks of our research delivered to your inbox. If you qualify for our portfolio management service and you have more than $500,000 to invest, then please give me a call and we can have a discussion about that.